Hello, happy Thursday. And for you golfers out there, maybe more importantly, happy start to the Masters tournament here today. We have a ton to cover here ahead of basically the holiday. It's a little shorter week in terms of trading days here this week for Good Friday. But ahead of that, we've got income and inflation data. Plus, we kick off jobs week ahead of the real big jobs number that will come out tomorrow while markets are actually closed. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, data, trends that we're watching, and hopefully weed out a little bit of noise along the way. So I hope everybody is doing well and again, gearing up for a nice Masters weekend. I want to share just right out of the gate that tomorrow on Friday, April, was that 7th, is Good Friday, and of course Easter on Sunday. So with that, we have markets closed Friday. We've had a lot of interesting data come out recently and will continue to in the week ahead. So I'll tip the cards a little bit on that, but also a great question of the week. I think a very important one lately, which is basically what is the best low risk investment? So we'll touch on that as well. All right, before we jump to that, looking back last week, we had personal income come out. Personal income was up 0.3%, personal spending up 0.2%, and core PCE, so another kind of inflationary measure, up 0.3%. Now, tipping the cards a little bit, we have inflation data, CPI data coming out next week. That will be the one to watch really closely. But regardless, this number shows that, inflation is still persistent. And basically this number kind of came in line with the expectations going into the week here. On Tuesday, we started jobs week. So basically on Tuesday, we had job openings number come out and actually saw for the first time shouldn't say that, but a significant first time in a while, job openings number decrease with 9.9 million job openings, which again is still kind of ridiculous at the end of the day. To be honest with you, it's a giant number, but it has dropped significantly from over 11 million just not that long ago. So still very, very high number, still obviously some discrepancies in the labor market without question, but it is an improvement. And so we'll see where that takes us. We'll continue to watch that. The theme as we move into Friday is we've seen some negative cracks in the jobs market for the first time in quite some time. On Wednesday, we saw ADP employment report come out. This was way below expectations at only 145,000 jobs added. But again, please take this with a grain of salt. We can't and don't want to rely on the ADP number too heavily yet. Remember that they discontinued this for a while to try and revamp it. And ever since it's come back into the data watch, it is not exactly the most accurate measure yet. So we'll keep an eye on that. But nonetheless, it's really all about the non-farm payrolls number tomorrow, Friday. Today, we did have initial jobless claims come out as well. And the initial jobless claims number is 228,000. So a tick up. And, in fact, I think this is the first time in a while we've seen it over 200,000. So when you kind of couple all this together, right, we've got job openings coming down, we've got ADP employment, so new jobs way below expectations, and initial jobless claims above expectations. Again, maybe some cracks in the labor market. As weird as that sounds, could be a good thing because of the giant discrepancy when you look at the job openings number. But tomorrow is really going to be the thing that we watch with the non-farm payrolls number, tomorrow on Friday. Coming up next Thursday, we will touch on that non-farm payrolls number, kind of debrief what we saw, but also we get Wednesday next week, we get CPI data. So it's going to be a huge factor. These 2 points are going to be a huge factor in the Fed decision coming up just about a little under a month away. Again, they're watching jobs, they're watching inflation. If the jobs number tomorrow is not what is expected or shows some signs of cracks and inflation may come down, that's where we could see a Fed pivot, but it remains to be seen. I think that, inflation still is showing it may persist. So we will see what comes out next Wednesday. I want to touch briefly on a question of the week, which is a great one from Betty, which is basically what is the best low risk investment? And this is always changing. The markets are always moving, and there should never be any sort of completely stagnant answer to, especially to this type of question. If you look backwards, best best low risk investment, obviously a lot of people may think cash. The challenge of that historically has been that there hasn't been any return for that cash. So I don't know that I would, consider that an investment necessarily. Here we are now, April of 2023, and there are a lot of moving parts, right? Markets are all over the place. Bonds are all over the place. Interest rates are up slightly. So what is the best low risk investment? What I want to share, though, is interest rates and kind of some of the benefits going on with that relationship right now. So let me put it this way. So basically, as we look backwards to end of 2021, the Fed has been on the most aggressive rate hike path we have ever seen. So with that, interest rates have come up significantly. So speaking of these cash investments, the 0.001% you were getting just 18 months ago now may start to look more attractive. If you look at money markets, CDs, those types of cash equivalent investments, they might be paying 4.5% or sometimes even more at this stage. So obviously that provides potentially some great opportunity for a very typically lower risk investment. Now, we need to be cautious of this, especially with money markets. You want to probably make sure that you know what the underlying assets are in that money market fund. But nonetheless, typically these are much lower risk investments and now are starting to pay, let's just say 4% or possibly even more, depending on what you look at and where you find it, right? So I think that is, that's something worth considering. Now, the challenge, of course, of really looking at cash equivalents or cash investments is, although you may get this interest rate, and very little risk of potentially losing or going backwards, it's still there, to be very clear, but very little risk to that. What are we giving up? And what we are giving up, of course, is the opportunity cost. So basically where I'm going with this is, although you may be getting 4% or more in a cash investment, if the market does turn, and the truth of the matter is nobody knows when exactly it will, you could lose some of that opportunity cost of much larger gains and opportunities, right? So it's something to really pay close attention to. Now, this year in particular, the last couple of years, we've been very cautious of talking about bonds, really, except very short-term bonds. Short-term bonds are still a good place to explore because they are paying maybe 4.5% with very little duration risk. In other words, when interest rates rise, short-term bonds do not get hit as hard. What I want to share, and a lot of you have heard me talk about this many times, but basically the relationship with bonds is, in simple form, is that as interest rates rise, bond prices fall. As interest rates decrease, bond prices can increase. So where I'm going with this is, as we've seen a little higher interest rate environment, not too long ago, we were at about a little over 4% on the 10-year bonds, right? When you find those types of opportunities, if you can get 4% for holding a bond, but also if interest rates come down, your bonds could increase in price, that provides potentially a great kind of risk reward opportunity. Over the last 18 months or so, stocks and bonds have almost been moving in lockstep. So if you think about it this way, if you can get 4% for holding a bond, but also have some opportunity where if yields come down, interest rates come down, the bond price can actually appreciate as well. It's a really good risk reward opportunity to explore. Now, I want to be very cautious of this because where we stand today on Thursday, April 6th, is interest rates have dropped significantly since that 4% mark. So this is much harder to time. You don't want to just do this, blindly. You want to be really cautious of when you actually explore this. And it may be worth considering what's called dollar cost averaging in if you are looking to buy bonds over time, because ideally, you don't know exactly where the height of the interest rates could be. So even if you bought in at 4 and they go up, you could lose money on your bond portfolio, right? Again, interest rates rise, bond prices fall. So without having that crystal ball, it's important to maybe dollar cost average in, do it over time periodically. And that way you can reduce some of that potential risk and spread out the impacts, to reduce that possibility as much as you can. You can't fully reduce it, right? But you get the idea. So I hope that's helpful. Again, remember, all this is ever changing. So, in a week, I could come to you with a little bit of a different answer, to be honest, but this is really what we're looking at and something we've been paying a lot of attention to in 2023 now that we see this relationship with interest rates. I hope that's helpful. Thanks for the great question of the week. Everybody have a great Easter weekend and a great Masters weekend as well. We'll see you next Thursday at 3.